In deciding to add a selection of top dividend stocks to your portfolio, you'll be investing in companies that distribute a portion of their profits to shareholders every 3 months. In this episode, we'll take a look at the 10 best dividend funds for any investor. But before we go too far, don't forget to hit that subscribe button so you don't miss the next videos on the best strategies to invest in dividend funds. Why invest in dividend funds? There are many benefits to investing in companies that pay dividends, especially if you plan to invest in them for the long term. In addition to providing consistent income, many dividend-paying stocks are in defensive sectors that can weather economic downturns with reduced volatility. Dividend-paying companies also have substantial amounts of cash and therefore are usually strong companies with good prospects for long-term performance. Dividend-paying stocks allow investors to profit in 2 ways. First, through appreciation in the price of the stock, and secondly, through distributions made by the company. Most companies pay dividends on a quarterly basis. Investors who are nearing retirement or already retired may gravitate toward dividend stocks as a source of income. How to identify high dividend funds? When trying to identify stocks that pay high dividends, investors sometimes use a measure called the dividend yield. The dividend yield is a financial ratio, expressed as a percentage, that shows how much a company pays out in dividends each year relative to its stock price. The dividend yield is calculated by taking the annual dividend per share and dividing it by the price per share. For example, if a stock trades at $25 and a company's annual dividend is $1.50, the dividend yield is 6%, $1.50 divided by $25. You can also identify companies with high dividend yields by using a stock screening service. 10 best dividend funds. 1. The Vanguard Equity Income Fund Investor Shares, VEIPX. The VEIPX from Vanguard focuses primarily on established US companies that are consistent dividend payers. The fund's holdings tend to be slow growth but high yield companies. As a result, the stock price gains may be limited when compared to other funds. This fund pays regular quarterly dividends and has an inception date of March 21, 1988. The VEIPX has an expense ratio of 0.28% and an SEC yield of 2.24%. The VEIPX has a $3,000 minimum investment requirement. 2. Vanguard High-Dividend Index, VHYAX. The VHYAX is an index fund that attempts to replicate the performance of the FTSE High Dividend Yield Index. This index contains stocks of companies which usually pay higher than expected or greater than average dividend. Being an index fund, the VHYAX replicates the benchmark stock constituents in the same proportion. This fund has maintained a consistent history of paying quarterly dividends since its inception on February 7, 2019. Now, being an index fund, this has one of the lowest expense ratios of 0.08% and an SEC yield was 2.75%. The fund has a $3,000 minimum investment requirement. It may be a perfect low-cost fund for anyone looking for higher than average dividend income. For investors looking for a lower minimum investment requirement, Vanguard offers this fund as an exchange-traded fund ETF, which has many similar characteristics. The ETF version is called the Vanguard High Dividend Yield ETF or VYM. 3. Vanguard Utilities Index, VUIAX. Vanguard Utilities Index, VUIAX, focuses on stocks in the utilities sector, which is highly sought for its high dividends. The portfolio holdings consist of large-cap US stocks of utility companies such as Duke Energy Corporation, DUK, and Southern Company, SO. The expense ratio for VUIAX is an attractively low 0.1%. However, this mutual fund is only offered in Vanguard's Admiral share class, which has a minimum initial purchase of $100,000. As an alternative, investors can buy the ETF version of the fund, VPU, for no minimum initial investment. 4. Vanguard Dividend Appreciation Index Fund, VDADX. Now, this is a large blend stock fund that provides exposure to US companies with a history of increasing their dividends. It's ideal for investors who are growing a long-term portfolio. As of November 2021, its current yield is 1.6% with an expense ratio of only 0.08% and the minimum initial purchase is $3,000. 5. Vanguard High Yield Tax Exempt Fund, VWAHX. The high-yield tax-exempt fund seeks to provide a high and sustainable level of current income that is exempt from federal personal income taxes. The fund invests at least 80% of its assets in investment-grade municipal bonds as determined by a nationally recognized statistical rating organization NRSRO, for example BAA, or higher by Moody's Investors Service Incorporated, or if unrated, determined to be of comparable quality by the advisor. It may invest up to 20% of its assets in less than investment-grade bonds as determined by NRSRO, for example BAA by Moody's or by the advisor. 6. Vanguard Real Estate Index (VGSLX). Vanguard Real Estate Index maximizes the impact of its ultra-low fee by accurately representing the broad US real estate market. Its well-diversified market cap-weighted portfolio should be difficult to beat over the long term. This fund looks a lot like the US real estate category average. Each portfolio may favor somewhat different property types, but their market cap and value growth orientations are nearly identical. 7. Fidelity Equity Income (FEQIX). The Fidelity Equity Income Fund is geared toward generating dividend income for investors. Manager James Morrow focuses on a combination of quality and yield. However, results have lagged the broader US market in recent years. Currently, the fund has assets totaling almost $7.89 billion invested in 132 different holdings. Its portfolio consists primarily of domestic dividend-paying stocks. The fund also holds a smaller number of convertible bonds and non-US stocks. 8. Fidelity Equity Dividend Income (FEQTX). The investment seeks reasonable income. Capital appreciation is a secondary consideration. The fund normally invests at least 80% of assets in equity securities. It normally invests primarily in income-producing equity securities that pay current dividends and show potential for capital appreciation, which tends to lead to investments in large cap value stocks. 9. The Neuberger Berman Equity Income Fund (NBHAX). The NBHAX looks to earn dividend income and capital appreciation by investing in high dividend-paying equities that include common stocks, utilities, real estate investment trusts, REITs, convertible preferred stock, convertible securities such as bonds, and derivative instruments like call and put options. The fund's inception date was June 9, 2008 and has a $1,000 minimum initial investment requirement. It pays dividends with an SEC yield of 1.5% and has an expense ratio of 1.06%. 10. The Vanguard Dividend Growth Fund (VDIGX). The Vanguard Dividend Growth Fund (VDIGX) primarily invests in a diversified portfolio of large cap and occasionally mid-cap US and global companies which are undervalued relative to the market and have the potential for paying dividends regularly. The fund research attempts to identify companies that have high earnings growth potential, leading to more income, as well as the willingness of company management to increase dividend payouts. The VDIGX has an expense ratio of 0.26% and an SEC yield of 1.48%. The fund's inception date was May 15, 1992, and also has a $3,000 minimum investment requirement. Frequently asked questions (FAQs). Before wrapping up this episode, here are answers to commonly asked questions. Why don't some companies pay dividends? Newer ventures, tech and growth companies often prefer to reinvest their profits into expanding the company and seeking new opportunities. As a result, they refrain from paying dividends, but due to growth expectations, they can instead return capital gains as share prices appreciate. Once a company has matured, it may begin to pay dividends. Can you live off dividends? So while you can live off the dividends from your investments, it might not be the optimal retirement strategy. You're generally better off optimizing your portfolio's total return than you are chasing a high dividend yield just for the sake of dividends. How do you choose a dividend fund? Dividend investors should seek out companies with long-term profitability and earnings growth expectations between 5 and 15%. Companies should boast the cash flow generation necessary to support their dividend payment programs. Investors should avoid companies with debt-to-equity ratios higher than 2. How many stocks should I own in a dividend portfolio? While it's highly subjective, we believe holding between 20 and 60 stocks provides a reasonable balance between the need for diversification, a desire to keep trading costs low, and a limited amount of research time to devote to maintaining a portfolio. That's it for this episode. Please give us your feedback in the comment section below. To watch more episodes on financial topics like this, hit that like and subscribe button. If you want to support us even more, buy us a coffee from the link in the description. Good luck and see you in the next episode.